What's up, degenerates? Welcome back to another video. I'm going to be covering a lot of what has happened in the stock market this past week and what I think is going to happen into year end as well as early next year. So we did have a lot going on. In last week's video, I did cover that we had equity futures roll dates starting on Monday through Friday. So that created a lot of volatility. Then we also had the CPI data that was released on Tuesday, which was lower than expectations, which would cause a rise in equity prices because signaling to the Fed that maybe they can slow the pace of rate hikes. Equities actually pushed to the upside, so SPY got it right up here around 410, which was the previous high on December 1st. Couldn't quite hold above that candle, and we broke back down to the downside for the remainder of the week. Most of this was driven by what was expected from Jerome Powell, the Federal Reserve Committee. On Wednesday, they raised rates 50 basis points, which you can see here, to 4.5%. And in addition, they're continuing to reduce the holding of Treasury securities, which is the balance sheet, which they have been doing. So this was, if you're looking at this is when they started printing money during the COVID crash, from 4 to 7 trillion, and then every single month they were doing these asset purchases, which was inflationary, push stocks higher, and now they have started to do quantitative tightening, which is reducing the balance sheet. So that's bearish for stocks. Same with raising rates, which they still are raising rates, so it's all still quantitative tightening at the end of the day. And so we did have that push down to the downside. Like I said, it was mostly priced in 50 basis points, which was probably responsible for most of this rally here. And then once they actually raised 50 basis points, it was almost like a sell the news event. We had that push to the downside into quad witching. Now, SPY did have ex-dividend date today, so that creates this drip, which is usually bullish in nature, but quad witching, it's a lot of different derivatives are all expiring on Friday, and so we still had a lot of chopping around during the day. Monday is QQQ. They have their ex-dividend date scheduled for Monday, so we might see a large inflow into tech, but it really depends. Like right now, there's a lot of bearish sentiment in the market, so it's really hard to judge how this will play out. Maybe we'll bounce Monday, but I still do expect this downtrend to remain intact, which you could see here is been rejecting off the top line here for SPY. And then with the Dow, this is what I talked about in last week's video. We actually did have that breakout, and I predicted that we'll come back and retest this line. So we're right on schedule. If we break below that line, then we're going to have a larger move to the downside. I don't know if it'll go that low, but we'll at least come back down and test this previous support around 298 and potentially even 287. If that breaks, we'll have a new low. That will most likely not happen until next year. I still do expect that, if we do break below this, that's considered a false breakdown, or a false breakout, I'm sorry. So we broke out above here, and then we're going to push down lower there. So that's something to watch for if we do decide to break this line around 323 to 320. Most likely we're going to see 299 and then maybe even lower than that. Now, something that's been interesting is what's been going on with the VIX. So this is the Volatility S&P 500 index. This measures volatility for the next 30 days using a weighted average between puts and call options on the S&P. And so when VIX is high, that usually means there's more volatility in the market. If volatility goes higher, then naturally stocks go down. So there's an inverse relationship there. This is also considered the fear index, if you will. So if volatility is higher, most likely stocks are selling off. So this is something that's been interesting. We've actually sold. We've been kind of basing all of this year a bit higher. So you can see here throughout 21, things were good. Earnings growth was high in the economy. Everything was great. We were trading around 14 to 15, 16 on the floor of VIX. And now throughout 2022, we've been in this higher floor around 20. anything over 20 is typically considered bearish. But obviously there's a lot of tail risk in the economy and the market, a lot of slowing growth, layoff announcements. Goldman Sachs just laid off 4,000 people today. So it's been in tech, Twitter, Meta, Amazon, Apple hiring freeze, but we're going to probably see more layoffs start to trickle into maybe financials, manufacturing, industrials, even like mom and pop restaurants, retail. Will most likely start to see some of that play out in 2023. So I'm still bearish on the overall structure of the market. I do think this downtrend will continue. The Fed is going to probably slow to 25 basis points in February, which is the next meeting. And it's really hard to say like exactly where we'll be with like CPI. So like how inflation is playing out. The Fed came out today and said that they still don't have much confidence in bringing in inflation. So we'll see how they react to that data. I do think treasuries have bottomed because the terminal rate is around 5 to 5.5%. So TLT, which is the 20-year treasury bond ETF, I do think that this has bottomed. It might chop around a bit here, but we're coming up on that retest of resistance here at this line. And if we break above that, we should see a push higher, potentially to 120, which is pretty common in bonds or stocks. You'll see yields go lower in most bear markets, which will also lead stocks. So that's something to watch for as well. Next week, we have VIX expiration on the 21st. So we might see some volatility there. The big thing for me is looking at the structure of VIX, which I mentioned before. So right now, the expiration date probably won't create too much because it's not disconnected. So this is the spot VIX is the green line, and the blue line is the VIX futures curve. And so these contracts are trading much higher into 2023. So right now, 22.6. But you look at January, February, March, April, VIX is back up to 26, 27 in the late summer of next year. So traders are pricing in a lot of volatility throughout the remainder of 2023. So I fully expect the same thing as well. I don't think they're off base with that prediction. Just a few headlines here. Yeah, still risk to the upside on inflation, which is certainly possible if they start to slow the pace of hikes and they almost flatten it out. A lot is still happening in the market, and obviously the Fed can't really control the price of food or energy all that well, although Biden will try to release as much SPR, the strategic petroleum reserves for oil, to bring energy down. So we'll see how things go. I guess I'll cover a few setups that I'm looking at if you're trying to play to the downside. I think Netflix is a great short position here. It did come up and retest and fill this huge gap that it had on its second bad earnings. And I do think that was probably the local top here. And so if we come back down, we'll probably retest this little gap here around 250. And let me see if I can zoom in a little bit better for you. So if we do come back down, fill that gap, maybe we'll bounce here or right around the 200-day. But that's probably my target, the 200-day, which is at 251.60. So that's a good short setup. Maybe if you're looking to play like January or February contracts. If that breaks, we'll probably come back down and test this support level where it was previously chopping around in this range, around 210. So I would look for that 250. If that breaks, we'll probably see 210. But Netflix been getting their lunch eaten by every other streaming service provider. Their content is not as good as it used to be. A lot of other competitors in the space now. I don't like Netflix as far as like a long-term hold. Another one is Ford. Now, if you were in my Discord, which is in the link below, we talked a lot about Ford, a lot about auto industries, and Ford was trying to break above this 200-day for quite some time. I just kept scaling into puts, and then now it's finally starting to break to the downside. I do think that it'll come back down to that 11 level. Now, autos do terrible in recessions because they're big purchases for most consumers. And so I do expect a lot of headwinds for the overall auto industry throughout 2023. Same thing with Tesla, been absolutely just getting demolished. Elon's even been selling shares of this. I think that will probably come back down and test this 140 level, which was that previous breakout way back in November, which we did play to the upside if you were in our Discord. But I will say that I think we'll probably come back down to like 100 at some point next year. That's almost given. And if you still think about it, this was the pre-COVID high before we sold off in 2020, which was around $63 before all the stock splits. So I'm definitely bearish on Tesla. Another interesting one is Royal Caribbean. So if you see here, this is the previous breakdown point, which is now acting as resistance, and we just broke below the 200-day moving average. So it's certainly possible from a technical perspective, we'll continue to see a push to the downside. Now, most people do go on cruises during the winter, and so that winter holiday season where people are traveling to warmer climates to go on cruise ships, most likely this rally to the upside was in anticipation of that, and we'll probably see a seasonality effect on this stock. We'll probably see a push lower to the downside. This company has had a lot of issues with COVID. It took out a lot of debt to service its operations, and I do think they're going to have a really big issue with servicing their debt throughout the remainder of 2023. And who's going to want to go on vacation and holidays when there's a lot of more unemployment, layoffs, recession? A lot of people are going to cut back on that discretionary spending. So pretty bearish on travel industry stocks. And the last one is Rivian. This kind of goes along with Ford. I've been shorting this and talking about this for a while. This company right now is trading for a 21 billion market cap. It was trading for around 30 up here. It's gonna just keep getting crushed because this company really doesn't make any money. It's still a new company, but the EV industry has been hot for a while. Tesla's gonna lead everything lower. You see Lucid here, which is somewhat similar to Rivian in a sense that it's a new EV company, and this one has just been getting destroyed. At some point, it was trading up for $50 to $60. Right now, this one I think is down to 13 billion market cap. I expect Rivian and Lucid Rivian will probably start to try to catch up to Lucid on its market cap, so I think it's going to head much lower, probably break the all-time low around 20. I do have a price target of $10. So that's it for this video. I hope you guys enjoyed. I hope everyone has a lot of plans for the holidays, for Christmas, and the New Year's. So I'll probably be around. I might release another video during the week. Really hope that you appreciate everything that I'm doing here. If you want to talk to me directly, go to either drop a comment below or go into our Discord. You can talk to TJ, which is the co-founder of Ticker Wizards, as well as myself. My name's I'm So Cold in there. That's my moniker. So check us out. There's a free trial as well if you're looking to get more into stocks and level up your trading. We offer a 7-day free trial, and we'll probably have some holiday sales here. But we do have a bunch of free content in there as well. So make sure to check it out, and I'll see you in the next video. Peace.